High performance firms have a deliberate structure with clear roles. Leave does not impact productivity. Time added in our net write-ups, those are the two relevant parts of the WIP equation we use for our team performance reporting. You can't escape the average hourly rate, but if we don't have enough cash to make our next hire, we can't bring on more clients because we can't deliver the work. My name is McTavish. I'm the CEO and co-founder of Link, which provides practice management for high performance accounting firms. Reason for making these videos is to teach you the art of firm management, which is centered around 5 core principles and how they all play together. There are 5 key metrics high performance firms look at every month to ensure they are headed in the right direction. In this video, we're going to look at what each of these metrics is, how we calculate it, and how we use them to make informed decisions. So how do I know this stuff? That is a great question. My name is McTavish. I'm the CEO and co-founder of Link, which provides practice management for high performance accounting firms. I've spent the past 15 years working with accounting firms, and I've seen the data of over 1,000 firms, which allows me to see what's working and what makes firms struggle. So my reason for making these videos is to teach you the art of firm management, which is centered around 5 core principles and how they all play together. So here we're going to be looking at these key metrics and how high performance firms are using them in their firm to make better decisions. So in this video, we're going to be looking at the 5 metrics high performance firms use to grow. We've got the WIP multiple, productivity, write-ups, average recovered rates, and average hourly rates. So metric number 1 is the WIP multiple. Now WIP multiple is the work in progress multiple. So to understand work in progress, first of all, work in progress is work done, not yet invoiced. So if we agree that I'm going to do some work for you and my billable rate was $200 per hour and I did 3 hours of work, I would accumulate $600 of work in progress. That's an asset to me that I can exchange at any point for an invoice, which is another asset, which you'd then pay, put in cash in my bank account, which is another asset. So the first asset is the work that I do, that's the work in progress. And then the accounts receivable, which is the invoice, that's the asset next. And the final asset is the cash in my bank account. All of these are assets, they're just changing from one form to another, but it all starts with doing the work at an agreed rate. That is work in progress. But work in progress can also be expressed as an equation. So put very simply, it's work done, not yet invoiced, but we can look at work in progress over a period for multiple jobs, multiple clients, and multiple people. So the WIP equation is opening WIP, opening work in progress for the period, plus time added, plus disbursements added, less invoiced, plus net write-ups, giving us our closing WIP. So if we add all of these lines together, we end up with our closing WIP. So let's look at an example here. So let's say in April 2026, we have $600 of time added. So that's $200 per hour, 3 hours work done, $600 of work in progress, work done, not yet invoiced. Now, that gives us $600 of closing WIP in this period. Now, in April 30th, 2026, that's our closing WIP, which means on the 1st of May, 2026, that's our opening work in progress. So closing WIP from one period becomes the opening WIP for the next period. All makes sense, right? Cool. So right now our closing WIP at May would also be $600 because there's no other movements, no other activity that's occurred in this period. But if we do a $200 timesheet entry, so 1 hour at $200, we now have $800 of work in progress. So now if we send an invoice for $1,000, we now have negative WIP showing up in this equation. So time and disbursements. So disbursements are anything that is non-time related that has value, which could be a contractor's fee. A contractor gives you an invoice that you on charge to a customer. It's not time, it's a fee that we're on charging, so it's a disbursement. You also have travel and accommodation and other fees you can charge. Those are all disbursements that are not necessarily time. But both of disbursements and time are positive work in progress. They increase work in progress because that's an asset that we're building up that will exchange for an invoice. Now, when we invoice, that's a negative in our equation because we're reducing our work in progress because we've turned that work in progress into its next form, being an invoice, and eventually it's going to turn into its final form, being cash in the bank. So invoices are negative in this equation because they reduce our work in progress. We now have negative $200 of closing WIP, which is not what we want. We don't want to close a job out with negative WIP. So instead, what we do is we do a WIP wash up where we take the invoice value being $1,000 and we apportion it to the time that we have, which is $800, giving us a $200 write up. So we can balance our equation back to zero. So if we take the $600 opening WIP and we add our $200 of time, we have $800. Subtract our invoice value being $1,000. We then have our write-up of $200. brings us to 0 work in progress. Pretty simple, right? Cool, so I'm gonna change this slightly because I wanna show you a write-off now. So let's say we had $600 of opening WIP from our April period, and then we added $1,000 of time, right? So that gives us $1,600 of WIP. And we're to invoice $1,000, we're gonna arrive at $600 of work in progress. So right now, we're showing that we have $600 of work we've done. We've got $600 of an asset, but that's actually not true because we can't invoice it because we've agreed on a $1,000 value for this job. So what we need to do, we need to write it off. This is where we have our write-off, which is negative $600, balancing our equation back to 0. So this is a complete job now. Now, one last example I want to give you here is I want to focus on negative WIP because negative WIP does exist. So in April 2026, let's say I send an invoice for $1,000. No work done, just the invoice. We can have closing WIP of $1,000 here, which is fine. It's just that's how we close the period out, and that becomes our opening WIP for the next period. So in May 2026, we'd have a negative $1,000. So what that means is we have sent an invoice, and assumably that invoice has been paid. So I've now got $1,000 of cash in my bank account, but I haven't done any work yet. So negative WIP is cash in the bank, assuming the invoice, of course, has been paid. So negative WIP is a liability to me because I've got the cash in my bank account, which is the asset, but the corresponding liability is that negative WIP because I haven't yet done the work. So negative WIP is actually, despite it being a liability from a WIP perspective, is actually a good thing because I've got cash in the bank. So my closing WIP, negative 1,000 because we've got no movements in this period, and then we add some time being $700, negative $300 of closing WIP, but we don't want to close this job out with negative WIP on it. Otherwise, we'd have all of our jobs always closed with positive and negative WIP balances. Then we'll have no idea what's going on. What we really want to do is do our WIP wash-ups, recognize this $300 write-up, giving us closing WIP of 0. And these net write-ups are what become really, really interesting, and we drive so much of our reporting from these net write-ups here. So now we have seen work in progress. We understand the equation. Now we're going to go to the next level where we look at WIP performance. So WIP performance is taking this to the next level, right? So rather than looking at a single job, we're now going to look at the movements across the entire firm. So we've got the same equation here. We've got opening WIP, time added, disbursements added, invoice net write-ups, closing WIP, and I've got a new value here called WIP multiple, which is what we're focusing on here. Then we've got our periods here. So I've got November, December, January, February, and March. Now, in reality, we probably want to run this for a 12-month period so we can get a perspective of our whole year, or you might want to run year to date. But generally, with a WIP performance report, you're running for multiple periods because we want to see the movements of work in progress in and out of these months. All right, so we have our values for November. Again, this is at a firm level, right? So you can see that we've done $105,000 of time. We've invoiced $75,000, recognizing $6,000 of net write-ups. So our closing WIP, so we opened the period up with 130 grand of WIP. We've closed the period with $164,000 of WIP. So we've had our total WIP increase. And there could be 1,000 jobs that make up these values here, and we might have 20 team members making up these values. So there's so much going on behind these numbers. I think of it as like a helicopter view of what's happening in a firm. So our closing WIP 164 becomes our opening WIP in December, doesn't it? All makes sense. Cool. And then we have our values for December, and we close out 155,000. So we've actually reduced our work in progress this month, which is a good thing. You can see that we've invoiced 95,000, but between our time and disbursements, we've only got $89,000, plus we've had our net write-up. So we've had a reduction in our WIP. So ideally, we want to keep our WIP as low as we can. So that becomes our opening WIP for the next period. And then that becomes our opening WIP all the way through, right? And then we have our totals here. So our totals, when we're looking at the WIP performance over multiple periods, our opening WIP becomes the start of our report. So our report started in November with 130,000. The time added was 460,000 across these months. Disbursements 45K, we've invoiced 395,000, net write-ups of 14 grand, and our closing WIP will be our closing WIP at March. So again, ideally, you'd want to do this over 12 months, or we have a month to date for these totals here. Now, WIP multiple, that's why we're here. This is why we're here today. So WIP multiple is looking at the value of time and disbursements added. So the new WIP created in the period divided by the closing WIP for the period. So we've got 1.4 here. And what that says is we've got 1.4 months worth of WIP sitting in our closing WIP balance right here. So what that means is we've paid for our time and we've paid for our disbursements. So let's say in November, we've paid our wages and we've paid our disbursements. Those are all gone out, but they're sitting here as closing WIP, which means we've paid all that money out and we've got 1.4 months worth of WIP sitting here. And if we go to December, we've got 1.7 and then we go to 2.1. So what's happening is we've paid all of our wages for the time that we've done in January and December, but we haven't invoiced a cent of that work that we've done. So we ideally want to have our WIP multiple under 1. That means that we're turning our our work that we're doing, we're paying wages on, and we want to turn that into cash within that month, which speeds up our cash flow cycle. But right now, looking at this, we're seeing 2.1, which means that we've got 2.1 months worth of work uninvoiced, which means it's not in our bank account, but we've paid for the work to get done. I've seen some crazy WIP multiples. I've seen up at like 10, 11, 12 months, which means people have done an entire year's worth of work. They've paid their wages for an entire year and they haven't invoiced any of it. So they just have this forever accumulating WIP balance. So then we go to 1.9. March goes to 1.9, and we don't have a WIP multiple on the totals, because a WIP multiple is something that we do in a month, because we want to look at how much WIP do we have in relation to the amount of work that we've done in that month. So WIP multiple is the first thing you want to focus on. You really want to get that under a month. What we can also have is negative WIP multiples. We do have some firms that use Link that have negative WIP multiples. So they've got like -6 and -7. That means they have 7 months of cash ahead of where they are in their trading right now. So they have positive cash flow because they've sent those invoices without doing any work. So ideally you want a negative WIP multiple, but if you don't have negative WIP multiple, you ideally want to make sure that it's under 1 and not creeping up above 1 month. Cool, that's the WIP multiple. Metric number 2 is productivity. So once we've got our WIP under control and we don't have a forever accumulating work in progress, we next want to focus on our productivity. So productivity is the ratio of billable time to total time worked. Put really simply, work that is productive is assigned a billable rate. So we have work that we do for clients, that's productive work. We have work that we do that's for internal purposes. So that could be internal meetings, it could be training, it could be any administration, office administration, that is non-productive work. So work that is productive has a billable rate. So it's client work, very simple. Now there's a formula that we use to calculate productivity, and it's billable time divided by total time. So I want to highlight something here, which is that leave does not impact productivity. So there's some weekly timesheet calculations we're going to look at here. So we've got our days of the week, and let's say on Monday we did 6 billable hours. So in total here at the bottom you see 6 hours. We did 2 hours non-billable time. Total hours we worked was 8. No leave in this part. So our productivity for Monday was 75%, which means 75% of our time we spent on client work. Now Tuesday we did 4 hours and 4 hours. So we had a 50-50 split between billable and non-billable, no leave taken. So our productivity on Tuesday was 50%, but on a weekly level now, we're looking at the bottom values here. We've got 10 billable hours divided by 16 total hours, which gives us 62.5%. So right now, that's where our weekly productivity is sitting. On Wednesday, we took the day off. So we logged 8 hours leave. So we have all hours that looks at all hours that have passed in the firm. So we've done 24 all hours, but total hours ignore leave, right? So the reason I've put that in there is to show you that we go billable, non-billable, then total, and leave sits outside of that because leave does not impact our productivity. So there's no productivity calculation for Wednesday because we're on leave. So our productivity has not changed at a weekly level because Wednesday did not count because we weren't there. That should give you peace of mind knowing that if you go on leave, your productivity will not reduce. Right, so productivity can be measured at an individual, a team, and a firm level because individual, team, and firms have both non-billable time and billable time, so or internal time and client time. I have both, right? Which means we can calculate productivity. A client, on the other hand, can't have productivity because a client, we only put billable time to it. There's no non-billable time on clients. Now you should aim at 55% productivity at a firm level. And that is because we've done benchmarking across multiple countries, multiple years, and the average productivity for an accounting firm sits between 54 and 56%. So we're quite confident saying 55% is the average, and the standard distribution of that is, it's incredible. It pretty much all sits within a few percent. Now firms that are above 55%, we call those high performance firms. Those are the ones that are performing really well. So you really want to be aiming at 55% or above. Now, this is really important. If we get our ratio of administrators to billable people wrong, we will find ourselves in a situation where we don't have enough cash to create more capacity, to bring on new clients, and we find ourselves stuck. So the game of growing a firm is we hire to create capacity, we then fill that capacity with new client work, and then we create excess cash flow to hire and create more capacity. So that's how we grow the firm. But if we don't have enough cash to make our next hire, we can't bring on more clients because we can't deliver the work. So if we have too many administrators, we're going to find ourselves stuck. So it's so important, we're going to look at an example of this. So we've got all these metrics here, and we've got our firm of 5 people. David's our partner, Jane, Henry, and Tim, our accountants, and Kate is our administrator. So David's target productivity is 50% and his rate is 250. We're expecting him to generate $200,000 of revenue, $120,000 cost, $80,000 gross profit on David. Now Jane is 81% target productivity at $150 billable rate. So we're expecting $95,000 GP. Henry, the same numbers. Tim, 75% productivity, but a slightly lower cost rate for us. So $100,000 GP there. Now, Kate being an administrator, all of Kate's time is internal. So her productivity is 0. So she has a gross profit of -80. So basically her cost becomes our loss. But at a firm level, we're looking pretty good here. We're looking pretty good. So we pay for 8,000 hours. Of those, 58% of them are client work. So that's above our 55%. And as you'll see, these numbers look pretty good. So we've got 290,000. So we've got $770,000 of revenue, less our salary cost being 480,000, 290K gross profit, less our overheads of 150K. Net profit 140. So we do have that cash flow. So we're doing just over $10,000 per month surplus cash. So this is looking pretty good. Now, we've got that excess cash, the firm's going well, new clients coming in the door, we're doing a great job. We hire James. James is another accountant, all right? So he's a junior, so his productivity is 75%, doing $80,000 profit for the firm. So now if we bring all these numbers through, 60% is our productivity. Now that's assuming we are operating at capacity. This is assuming that we click our fingers and then James has all of his work filled up for the whole year. So realistically, when we hire James, we'd need to fill his capacity over the next 6 to 12 months with bringing on new clients. But once we have brought on that work for him, this is what the firm would look like operating at capacity, which would be 60%. That's as high as we can get our productivity, assuming everyone hits their productivity targets. Everyone hits their targets, essentially. So cool, 170K is our overheads, giving us 200K profit. So this firm is rocking. We are going really, really well, except Kate is super stressed because Kate is now looking after all these team members. She's doing the marketing, she's doing the finances, she's bringing on onboarding new clients, so much work. So she comes to David, the partner, and is like, I'm struggling here. I need some help. I need someone to manage the marketing and I need someone to take over this reconciliations for me. So David's like, well, we're doing almost $20,000 a month surplus cash. All right, well, let's go. Let's build this out. Let's give you some support. So we go out and hire Mike, and Mike's a marketing whiz, comes on board, looks at bringing on some new clients, does a great job, got ads running, Facebook ads running, LinkedIn ads running, lots of new work coming in the door. And we've got Sue, and Sue's there. She's doing all the new client onboarding, all the reconciliations, and then we've got Kate managing the team. We've got this awesome firm, so it looks, but our productivity is now at 45%. At capacity. So everyone's full. We've got new clients coming through the door. Who's going to do the work? No one. Everyone's at capacity. So our net profit, -$10,000. So this is a big problem we see all the time as you start getting a bit of success and then you go, cool, let's scale up our marketing and get our administration function really nailed down and then we can really grow the firm. But then you choke yourself because you don't have enough cash to hire our next billable team member. So when you're hiring, you always need to keep an eye on what your target capacity is going to be at a firm level. If it drops below 50%, do not hire another administrator because you're going to find yourself locked where you can't actually grow out of that low productivity. These are just some general numbers to keep in mind. So of course you might be paying people a bit less than what we're seeing in here, or people's billable rates might be higher, but it's worth doing a model like this to understand, are you going to find yourself without cash if you bring on these administrators? And generally a rule of thumb is we want to keep our firm operating at or above 55% productivity. Right, so high performance firms have a deliberate structure with clear roles. Metric 3, write-ups. So write-ups and recoverability are sort of under the same umbrella, but recoverability is the percentage of work performed that converts into billable revenue after adjusting for write-ons and write-offs. So if we do some work and then we write some of it off, we're able to say, let's say we did $1,000 of work and then we were to bill $900 of it, we'd have 90% recoverability. And then the inverse of that is 10% write-off, which is our write-off. So another way to think about recoverability or write-offs is it measures how effectively a firm turns effort into cash. So we have our productivity, which is, are we working on client versus internal work? So we want to increase our productivity. But then once we've got our productivity up, the next thing is we want to look at our recoverability to make sure the work we're doing for our clients isn't all just getting written off. So we want to make sure it is turning into cash. All right, so we're familiar with our WIP equation here. So we're going to look at it from a team member perspective now. Now to keep things really simple, we're going to have no opening or closing WIP because we're going to look at that shortly. But to keep things very simple, for an introduction to this concept, no opening or closing WIP. So we've got Kate, who has added $27,500 of time, invoiced $23,400, so we've got a $4,100 write-off. And our mate Ted here has got a write-off of $3,900, so about $200 differences in their write-offs. But we look at these two and go, cool, they've both got write-offs of around about the same amount. The story doesn't finish there, however. If we look into this a bit further, to investigate write-offs, we want to look at identifying patterns versus outliers. So in Kate's jobs, She's got her 5 jobs here that made up those values that we saw. And what do we see for Kate? We see a pattern of write-offs, which means she's not performing at the billable rate we've assigned her. So in general, you want to take someone's cost, so what we pay them, and you multiply that by 4, that becomes their billable rate. That's a really rough rule of thumb. So if we're paying Kate $50 an hour and we charge her out at $200 an hour, we would expect her to perform at that rate, but she's writing off a significant amount of her time. So that's where Kate isn't performing at the rate that we've given her. So we want to help her and support her and find out what we can do to help her improve her recoverability. Now, if we look at Ted, we've got a very different situation. With Ted, he's actually getting write-ups on all of his jobs except job number 5 here. So the first 4 jobs, quite significant write-ups on. So he's doing great, he's performing over and above his billable rate, but something's happened with job 5 here. Either we haven't communicated the budget appropriately to him, so he may have, in the workflow system, we may have not put the correct amount of time in there. And on top of that, we may have put the wrong budget in there and the job was bigger than expected. There's so many things that be going on with this job number 5, but we really want to have a chat to Ted about this write-off here. And if we just look at that 3,900, we'd have no idea that he's actually had an awesome month apart from this job. So there's so much information we can interpret from here. So the next thing here is metric 4 is average recovered rates. Recovered rates are great because they allow us to cut through all the noise. So we do want to analyze write-ups and write-offs from a patterns and outlier perspective, because as you've seen here, we want to know that Kate was not performing because she has a pattern of write-offs. So that means that when I say she's not performing, she's not quite performing at the rate that we've given to her. Whereas Ted is actually overperforming, but he had a bad job in his list, or he's been stacking his time there and doing something naughty. So there's 2 ways that one could go. But drilling down into the write-offs allows us to see this. But recovered rates allow us to cut through all the noise here. Let's look at recovered rates. So recovered rates is revenue divided by the billable time, and that's in hours. So let's say we have Ted's billable rate is $200 per hour. Now, what we can do is we can go, well, if he actually managed to recover $250 on that job, we could say that his recovered rate was higher than his billable rate, and this is what this formula allows us to do. So revenue divided by billable time hours. So revenue is time added plus net write-ups. Now revenue is a new concept here because we haven't looked at this yet. So the question is, why do we use revenue to calculate recovered rates? Why can't we just use invoiced? And that's because we have WIP that flows in and out of periods. So let's look at April 2026, and let's say I did $600 of work in April, but I sent an invoice, a deposit for $10,000. So we'd end up having a closing WIP balance here of negative $9,400. But if we were to look at this month and say, well, what was our recovered rate here? That $10,000 couldn't be assigned to anyone because there's a mismatch between the work done and the invoice. If we were to say, right, well, there was 3 hours done this month and there was $10,000 invoiced, we'd arrive at a rate that's $3,333, which is ridiculous. That's not the recovered rate on the job. What we'd say is there's a $600 time, there's 3 hours done, so the recovered rate at this point in the job is $200. Now, let's look at next month. So in May 2026, we have $9,400 of a negative WIP. So we add $11,000 of time, giving us $1,600 of closing WIP, but we know we're going to end up writing that off because we can't bill it. There we go. So now what we do is we can look at this and we go at a total level, the time added was $11,600 and then the net write-ups was $1,600. So if we take the $11,600 and we subtract the $1,600, we arrive back at the $10,000 that was invoiced. So the point I'm trying to make here is that revenue always reconciles back to the invoice total. It just deals with the fluctuations of WIP falling in and out of periods. Otherwise, if we've got all these jobs open, we can never accurately calculate our recovered rates on jobs unless we close every single job, then run our rates and then start the new jobs. But in reality, we've always got jobs opening and closing all the time. Therefore, we're never going to get this period where there's no jobs open. So that's why we can't ever use invoice to calculate our recovered rates. We have to use revenue because it deals with the flow of in and out of work in progress in periods. So hope that all makes sense, but it's a really important point. Write-ups are indicative of billable rates, which is why recovered rates are so useful. So when we're analyzing write-offs, we could look at someone and go, oh, they've got lots and lots of write-offs, they're doing bad, or they've got lots of write-ups, they're doing good. But again, we can cut through the noise with our recovered rates, and write-ups are indicative of billable rates, which I'm going to show you here now. So let's say Ted's billable rate is $200 per hour, and that's how we arrive at his time and his net write-ups. So we just want to focus on time and net write-ups because invoiced is not useful to us when we're looking at team performance. We want to focus on time and net write-ups, which again, they reconcile back to invoiced once the job's finished. So we want to focus on just time added and net write-ups, and that's because invoiced is not useful to us in this because And we're going to calculate revenue here, which reconciles with our invoice total once the job's closed. But at least this deals with being able to run rates in any period and not waiting for us to close all our jobs. Cool. So we've got our time added and our net write-ups. Those are the two relevant parts of the WIP equation we use for our team performance reporting. Then we can bring in write-up percentages, revenue, hours, and recovered rates. So our write-up percentage looks at the percentage of write-up against the time added. Then we've got our revenue, which again will reconcile back to the invoice total. So if we do look at the example I gave earlier, and I mentioned that we're going to have no opening and closing WIP to keep things really simple, but if we did have WIP flowing in and out of periods, the invoice won't necessarily align with the revenue there unless we're looking at the whole job. So anyway, time added plus net write-ups arrives at our revenue. Then we have the hours that went into creating the time added. So if you look at this job one here, we've got 10 hours of time added, creates $2,000 of work in progress. When we invoice it, we recognize a write-up of $1,000, arriving at $3,000 of revenue. From there, we can calculate our recovered rate. So our recovered rate is taking the revenue, being $3,000 on this first job, divided by the 10 hours, we arrive at $300 recovered rate. So Ted's billable rate's $200 per hour, but on this job, we recovered $300 per hour, which is a 50% write-up. See how it all starts to reconcile now. But we had that job number 5 that really hurt us. We had 90% write-offs. So we recovered $20.69 on this job. And that might sound crazy, but every firm has a handful of jobs that they charge $15 to $20, $25 an hour for. And they're generally quite big jobs as well. And it's because they've taken an absolute bath on it. They haven't priced the job properly. They haven't managed the team properly. They haven't captured the appropriate estimated hours in their workflow, and they've absolutely destroyed their budget. There's always a handful of clients that is about $20 an hour. So it might sound crazy, but it happens in every firm. Now, Ted's recovered rate for the month across all his jobs, $177.95. So his billable rate was $200, his recovered rate was $177.95, and that's because he wrote off 11% of his time. There we go, it all reconciles. Now, as a thought experiment, let's put Ted's billable rate up to $600 per hour. So when we do that, the time added is going to triple. We've tripled his rate, the time added triples. Then we have large net write-offs, large net write-up percentage, and the write-off percentage, and then our revenue does not change. The revenue doesn't change because it always reconciles back to what was invoiced. We've got our hours here, so our recovered rates don't change, and that's what I want to highlight here, is that even by changing Ted's bill rate to $600, we make it $1,000, we can make it $5,000 an hour. We're going to create huge amounts of work in progress, but then we're going to write it all off, and we're going to come back to the correct recovered rates. And the recovered rate looks at the actual value that he created for the customers. And that's why recovered rates are great to cut through all the noise. Now, metric number 5 is average hourly rates. Now, this is our last one here. So average hourly rates is very similar to our recovered rates. So we understand revenue now. Revenue is time added plus net write-up. So those are the two parts of the WIP equation that we want to hold on to. And then what we're doing is we're bringing in time data, like hours, to calculate rates. So our recovered rate is revenue divided by the billable time, where our average hourly rate is revenue divided by total time. So total time includes our non-productive time. And what's interesting about this is our recovered rates are fantastic for clients, jobs, and services. So reporting against those because they don't have any non-billable time in them. A client doesn't have non-productive time. Neither does a job or a billable service, no non-productive time. Average hourly rates are fantastic for individuals, teams, and firms because these all have non-billable time built into it. So something I often say is you can't escape the average hourly rate. And that's because it considers both productivity and it considers recoverability into the same equation. So if we're looking at average hourly rate at an individual or let's say at a firm level, the value we arrive at looks at recoverability and how productive we were as well. So it's a great way to see how your team members are performing against each other and also how your firm is performing against other firms in the industry, because it just cuts through all the noise and it gives you a factual rate. That's what we recovered based on the number of hours we input into it. So what we're going to look at next is Ted's performance. So this is the time added and the net write-ups, and we've supplemented it with these time values here to arrive at our recovered rate. Now I want to look at calculating Ted's average hourly rate. So we'll take these values here and we're going to expand on it by adding in some extra values. So Ted's monthly performance. So we know his billable time, we know the time added, so the value of time added, we know his net write-ups, we know the revenue, we know the recovered rate, the internal time is a new value here. So this is the amount of internal time that Ted's done. We've got the leave taken and then the total time. So the total time is billable plus internal. So it excludes the leave, right? So that's our total time. So then we can calculate our productivity, which is 82%. So it's a high productivity for Ted. The cost, so Ted's cost, so to calculate the cost, we want to take Ted's salary and divide it by the number of contracted hours that he does, and that is arrives at an hourly value, and then we multiply that hourly value by the total time worked, excluding any leave. Otherwise, going on leave reduces our ROI, and you could say, well, great, we'll just look at over multiple periods and it all gets washed out. Well, what happens if he takes 1 week of leave in 1 year and he takes 7 weeks of leave the next year? Well, his ROI is going to absolutely plummet in that second year. He looks like he's not performing well. He's going into disciplinary meetings. The only thing that's changed is he took more leave that he's entitled to. So that's why calculating ROI on a fixed monthly salary is very dangerous, because you get into the death spiral and you start losing your top team members. So that's Ted's cost. Profit is our revenue less our cost, and then we can calculate our ROI, which we just spoke about earlier, which is profit over cost, and 225% is our current ROI for Ted. And his average hourly rate is his revenue divided by total time, which is 146.25. So this is Ted's average hourly rate. And what we want to do is look at our team members each month and look at all of them in a report and see what are their average hourly rates, who's up, who's down. And by looking at average hourly rates as an indicator, they can indicate what investigations we need to do around the write-offs. So those are the 5 key metrics that every high-performance firm is looking at. If you are looking at growing a high-performance firm, or if you're in the process of doing it right now, consider subscribing to the channel. And I'd love to know in the comments which part of this video you found most useful. So let us know in the comments there. And I hope your firm is doing awesome, and I'll see you in the next video.